Hello, my name is Thomas Key, and I am President and CEO of Stock Traders Daily. Stock Traders Daily provides research, models, strategies, timing tools, and signals in general to institutional investors through portals like Bloomberg Terminals and FactSet and Refinitiv and such. And we also offer the same for do-it-yourself investors on StockTradersDaily.com. We started Stock Traders Daily in January of 2000 at the peak of the internet bubble, and we had to manage risk to survive. We had to do it. Market was reeling, and if we didn't, we would have cratered like a lot of others of our peers at that time. So risk control is in our blood. It's what we do as a business, and the models and strategies that we've developed over time all have risk controls as a primary objective. Risk control matters, and today we're going to talk about one of the models that we use to identify market risk. Yes, we're going to talk about it, right? We're going to talk about models that identify market crashes. And that's important, right? But it's not the most important thing that we're going to talk about today. What we're going to talk about today that's even more important is the setup of the account. Because over these years, we have learned something about investors and specifically how investors handle themselves when it comes to managing risk. And the answer is, if it's not easy, they don't do it. If it's not easy, they don't do it because it's a lot of work. At least the traditional way of going about doing things, it's a lot of work. But we're simplifying it here too. So that's going to be the most important thing, I think, about this presentation. It's about the setup. Let's get started. An introduction to risk management. Why is it important? To a certain degree, that's a relatively obvious statement or question to me, but it's not to everybody. Ask people in 2017 if risk management was important. They would say no. But that changes over time, right? Risk management, though, is important to us for two reasons. One is, and although this wasn't the primary objective in developing the strategy that we're going to talk about today, significant outperformance comes from managing risk. Significant outperformance, at least for our strategy. And I'll show you how. It's all rooted in the simplicity. In addition, though, we have to have something that's also easy to manage, right? That's important. And the obvious objective of risk management is to have lower degrees of volatility, right? So it has to be easy, has the ability to outperform, and have lower volatility. That's the objective. That's what risk management is. What we're really looking to do. The traditional models will have you diversify your portfolio, right? Many people own 5, 10, 20 stocks in their portfolio. The traditional way of mitigating risk will tell you to go through all of those 20 stocks and develop option hedging techniques for each one of them to reduce volatility. Maybe these are covered calls or some sort of spread or whatever it is. You're using an option, and the option market, it's expensive and it is not directly correlated. And it's a lot of work. You have to go through and evaluate the options chain for each individual stock, and you have to set a plan. That plan, after it's executed, for each one of the 20 stocks still does not protect your entire portfolio from situations like market crashes. It might reduce the impact a little bit, but there's nothing in that options technique that actually reduces and removes the actual risk from a portfolio. Today we're going to talk about the following. We're going to talk about the benefits, the reasons that we care about managing risk in a more tangible way. We're going to start doing that. And then we will talk about the setups for various account types. IRAs, 401ks, taxable accounts with big cap gains, tax consequences, and separately managed accounts. Strategies that already exist, right? You're already engaged. Maybe you do it yourself or someone does it for you. How do you manage risk in those? And then we're going to talk about the actual models that I use to help me identify crashes. So why are risk controls important? This is our Avatar Corte strategy calculator. So what we're doing in this calculator is we are comparing the performance of the S&P 500 alone to the performance of the S&P 500 with our Avatar Corte hedge on. The objective of the Avatar Corte model is to protect accounts from market crashes when market crash risk warnings come. And there have only been 4 of them from the model since 2000. Those were the internet debacle, the credit crisis, the period of time in 2019 when overnight lending rates spiked up to 8.5%, and the Corona crash. This model provides the bookends of those, right? It tells, well, not exactly, but it's the warnings came, and then the other end, the bookend of the warning also is signaled from the model. So it gives you both ends, right? It tells you when to protect your assets and when to get re-exposed. And if you look at the square box that I've made in the right-hand column, you can see 2 values. And I want to point these out because it's interesting to note that this is the period of time, this is a period of time, there have been a couple of them, when there's been a market crash risk warning from the model. Notice that the portfolio that has the hedge has no change in value. That's because the model completely removes all risk from a portfolio when there is a market crash risk warning on. Again, that's only happened 4 times since 2000, so it doesn't happen all the time, but it's impactful. And if this was followed, it's also 576% better than the S&P 500. It matters. That's one reason risk controls are important. I set this one up for one of the first 50 employees of Qualcomm. I compared an investment in Qualcomm from 2000 to now as well. And yes, Qualcomm's a good performing stock, but the hedge can be overlaid onto concentrated positions as well. And it can be overlaid onto a mutual fund, and it can be overlaid onto an existing strategy. You can use it to overlay and protect existing portfolios too, right? In the case of Qualcomm, I think it's 635% better if you use the hedge. It matters. The outperformance matters. What matters to me more, though, is the way that it does it. So this is a chart of the internet debacle, right? The blue line represents Avatar Corte. And you could see that it goes horizontal, flat lines, for a good chunk of time. And when it was neutralized, that, by the way, represents no volatility, no risk, sleep well at night, don't worry about anything, right? While that was happening for the people following this strategy, the market was reeling. The strategy achieves the outperformance by avoiding crashes. Now, that wasn't the intention, right? The way that I created this strategy was to avoid crashes. It just so happens that the performance is ridiculous. Because look what happens here. When Avatar Corte actually re-engages, on the right-hand side of the chart, when the flat line stops being a flat line, it's basically re-engaging in the market at a level that's 30-40% lower than when the risk warning was put on. So it's basically buying back or getting exposed again at a much lower level. And the outperformance becomes significant. That's why we care. And when I introduce this sort of thing to people, they start saying to themselves, yeah, this makes a lot of sense, right? I mean, of course, this needs to be easy, so I'm going to share with you the easiest, most efficient way of managing risk possible. But there's a truth, and that is that the only way you can get started doing something is to quit talking about it and begin doing it, right? So these risk controls and these account setups that we're going to talk about here, they're extremely important, and I would say it's more important now to be doing it when the market doesn't appear like an imminent threat or it's on the verge of collapse or anything, remotely associated with that, because you can also approach this sort of thing objectively. And that's important, right? You don't set up a plan when the shit's already hitting the fan. That's not a smart way to do it. You do it when everything's good. And it matters to everybody. I created these characters just because it's going to make it more relatable, right? Ellen has an IRA that she depends on. She's playing bridge all the time and going to the club and spending time with grandkids, and life's good. But if the market crashed, her IRA would be worth a hell of a lot less. You have Barb. Barb's still working. She's going for it. She's doing all kinds of things that she probably didn't do 20 years ago. And she's loving every minute of it. She's also contributing a bunch to her 401k, company matching. That 401k is huge, but it's really hard to manage risk in that 401k. And then you have Bill, who has a bunch of stocks at really, really low cost basis, and he's stuck in that traditional options hedging technique that, really doesn't do much to protect accounts. But it surely keeps the brokers busy and rich, I might say. And then you have Stan. And Stan manages his own money or hires people to manage it for him. And he has a plan. He's a good investor. He can evaluate stocks and look for things that are going to work. He has a method of doing it. But one thing that none of these people do is manage risk. And I would argue that most of the fund managers out there don't manage risk either. They get paid to invest money. They don't get paid to manage risk. So the question is, how do I manage risk for each one of these type of people, right? And that's what we're going to talk about now. My answer is, we do this by empowering our competitive advantages. We are much more nimble than the institutions out there. The guys that are telling you to engage in these option techniques, well, the only reason they do it is because they have to do it. They could never do what I'm going to suggest that you do. They can't make a portfolio completely neutralized from market risk. Not at their size. They're too big, but we can do it. So the way we manage risk is we employ our competitive advantages. And there's no more efficient way of doing it than inside of an IRA account. Keep it simple, right? That's what we have to do. It has to be easy. Because when the signal comes that something needs to be done, it has to be easy and it has to be fast, right, to execute. It can't be complicated. So for the entire account in an IRA account, we suggest owning SPY. That is the S&P 500 ETF. Every dollar, every penny in SPY. That's also If you think about it, it tracks the S&P 500. 92% of the managers out there underperform the S&P 500 over time anyway. So by owning SPY, which again tracks the S&P 500, sounds simple, but it's one of the top performing funds, investment funds out there. So you're doing something right from the standpoint of when you're invested, be invested in something that's good as well. But when a warning comes, and a market crash warning is important, all we need to do to completely neutralize that portfolio is to sell SPY. No warning, we own SPY. If there is a warning, we sell SPY until the bookend of that warning comes and the model tells us to get back exposed again. This is exactly the performance, the outperformance illustrated in that calculator. It's done simply by doing this in an IRA account. But there are other types of accounts. 401k, how do you do it? It's relatively the same thing, right? Except for in a 401k, most of them aren't going to allow you to buy SPY, right? If they do, do it because that's the best thing to do, right? But a close alternative, it's generally the same thing. It's an index fund. And I say generally the same thing because in a 401k, there are restrictions. You can't trade too much. By the way, this has only had 8 trades, or the Avatar Corte strategy has only had 8 trades since 2000. So you don't have to really worry about that restriction in the 401k for this strategy at least. But what they do offer is mutual funds. And the mutual funds that they offer typically include somewhere an index fund. And that index fund can be used as an alternative to SPY. It's essentially doing the same thing, tracking the S&P 500, right? But when you sell it in a 401k, you also have to submit paperwork, and because it's a fund, it doesn't sell until the end of the day. So there's some nuances to it, but it's generally the same thing. You either own the index fund or you're in the money market in your 401k. When the model tells you there's a risk warning, you're in that money market account. And in that money market account, there's no risk. So the IRA and the 401k are pretty straightforward, right? It's either exposed to the S&P 500 or not. Exposed or not. Very simple and straightforward. The twist comes when we do it in a taxable account, right? Because taxable accounts, they don't want to sell their underlying position, right? Because of cap gains tax consequences. At least that's the idea, right, of what we're going to be discussing here. There's 2 things that need to happen. Okay, the first thing that needs to happen in a taxable account, by the way, let's just assume that the taxable account is about $1 million, diversified portfolio, can't sell because of the large cap gains tax consequences, right? The first thing that we need to do is look at that portfolio and determine what market it tracks. Does it track the S&P 500, the NASDAQ 100, the Russell 2000, the Dow Jones Industrial Average? Figure out which one it tracks, right? And then use the double inverse ETF for that market to protect market risk. I'll show you what I'm talking about. So in this example, let's assume that it tracks the S&P 500, right? The double inverse ETF on the S&P 500 is SDS, Sam David Sam. And we will use that plus margin to protect risk. Yes, I said we will use margin and a leveraged inverse ETF to remove risk. If you go to Fidelity or Schwab or Vanguard or anybody and you ask them, if you add margin to your portfolio, does it increase risk? They will say yes. If you ask anyone, if I use a double leveraged inverse ETF, will it add risk? They're going to say yes. Right? This is just the way it is. But we are using it to completely remove risk. And I'll show you how. Take the $1 million portfolio in a taxable account, right? Use $500,000 on margin. So you'll have $1.5 million invested. You keep that $1 million portfolio exactly where it is. Take $500,000 and buy SDS with it. Essentially, you will have $1 million long the S&P 500 and $500,000 double short the S&P 500. And together, it offsets the risk in the taxable account without requiring you to sell any of the underlying positions. SDS is not as liquid as SPY, but all of the traders in SPY watch SDS and trade SDS as well. So if they get an opportunity to scalp, they'll do it. And so the activity in SDS is high as well. It is liquid. It is easy to trade. So a taxable account would use the margin and inverse ETF method to remove risk when market crash warnings come. So the next one, how do we set up risk controls in an existing strategy? And the answer is use a combination of these two methods, right? Some monies, in existing strategies, monies are doing different things at different times, right? And a lot of them are not that concerned about taking capital gains. And so maybe the SPY cash model from the IRA side, the simplest one imaginable, maybe that one's the best thing that you use, right? Maybe you use the margin plus inverse ETF method. That's fine too, right? Maybe use a combination of them for the separately managed account. You're doing the work here. You know the tools that are available to manage risk, and you know which parts of your accounts are best suited for those tools. So apply them accordingly. Either one of them will work. The important thing, though, is that we have a plan. Every account type needs to have a plan. What are we going to do when there's no crash warning? What are we going to do when there is a crash warning? Typically in a presentation like this, I would pause and make sure that there's all questions are answered, because that part of the presentation, the setup part of the presentation, is the most important part about managing risk. We're going to transition here and talk about the models that I'm using to identify when market crashes are imminent, when they're likely to happen. But the setup part of what we just did, it doesn't need to be used. That you can use that with any model. You don't have to use that with my models, right? It travels. If you want to use the market crash models that Goldman Sachs offers or Morgan Stanley offers, you could do it with this method, right? You could still use your competitive advantage. The setups matter, right? Let's transition to the models that I'm using. How do we see a market crash coming? I use two important components to my combined model. The first one is the investment rate. The investment rate is a derivative demographic analysis of lifetime investment cycles based on ingrained societal norms extrapolated across our population to define the rate of change in the amount of new money available to be invested into the U.S. economy annually, dating back to 1900 and extending out by decades. It measures liquidity. It measures the demand, the natural demand from people for new investments. And the new money matters. In fact, new money matters most because you can't churn old money, already invested money, and expect asset price appreciation. So on the one hand, we're looking at liquidity, the investment rate. And in addition to that, Avatar Corte. Avatar Corte is from the calculator that we talked about, right? Comparing the S&P 500. Avatar Corte is the model that helps protect accounts from market crashes. Avatar Corte uses the FOMC as an indicator. All of the components of the FOMC built into an algorithm that spits out warnings and tells us when the crash risk is imminent. And again, there's only been 4 of them, right? And one of them didn't really amount to anything, right? You had the internet debacle, sure, right? Credit crisis, yes. Period of time in 2019, Corona crash, yes, but that period of time in 2019, that didn't really amount to anything in the stock market. It did, however, in financial circles, right? The FOMC, there was a mini run on the FOMC. Overnight lending spiked up to 8.5%. They had to reverse all of the QT that they were doing, all of the balance sheet reductions that they were doing. They had to reverse it all in one day. They've been doing it for like a year and a half. They had to reverse it all in one day. It was serious. It could have amounted to a lot. It didn't, but there was a risk, right? This model, this combined model, is very good at identifying risks. It identified the Great Depression, stagflation, the internet debacle, right? NASDAQ declines by 76%. The credit crisis, market down by 50%. And the corona crash, market down by 66%. It's effective, it's efficient, it's able, it's proven. And this is what we use to identify risk. It's all based on a simple process of keeping it simple at all times, right? What we've learned over the past 24 years at Stock Traders Daily is that investors don't manage risk unless it's easy to do. And they also don't manage risk unless they have a plan. And that's why we're setting up a plan, right? We want to have a plan. So the setup matters significantly. And then after you have a setup and after you have a plan, all you do is monitor for warnings. And when the warning comes, again, you don't need to use our models, right, for warnings. You can use a model from Goldman Sachs or Morgan Stanley, or if you have one, yours. Monitor for the warnings and then execute. And keep it simple. SPY cash for the IRA, easiest thing you could ever do. And if you did it, since 2000, you're beating the market by 576%, and you're doing it with lower volatility. You're doing it while being completely protected from market risk during market crashes. While everybody else is a little bit freaked out because you know how it gets, you're sleeping well at night. You can find the information related to our models and how we do things, how we set up accounts and such, and our other strategies and tools that ultimately produce these models. You can find all of that on Stock Traders Daily at stocktradersdaily.com. I suggest that you take a trial to our Platinum subscription if you are not already a Platinum subscriber, because you'll need to have Platinum access in order to access our Avatar Corte model and our investment rate. That requires Platinum access. So take the Platinum trial if you haven't already. Look at more details about both of these components of the model, and think about what we're suggesting that you do, right? What we're suggesting that you do is invest in the most liquid instrument in the world unless there's a market crash risk warning from the Avatar Corte model. And if there is, sell that thing and go to cash. What we're suggesting is a very simple approach that the institutions simply cannot do because it would devastate the market. They're just too big. We have a significant competitive advantage, and we should be using it. My mantra is that defense wins championships. The Avatar Corte model was built with that specific goal in mind: protect accounts from market crashes, and it just so happens to have this significant outperformance. Thank you very much for your time. I hope you have enjoyed it, learned something, and are ultimately walking away with some interesting thoughts and maybe some questions, right? If you have any of those, please go to stocktradersdaily.com. Make sure you sign up for a trial and then ask your questions. And we'll point you directly to what you can use to find answers to those questions. We also have extensive data on the performance of all of our strategies and the tools that are being used to make those strategies work. Thank you very much.